Hi, welcome to Global Forex Academy. Learn how to trade in partnership with Global Forex Institute of Africa and in connection with Exclusive Forex Trading Academy. Thank you very much for joining us. We welcome you to our video. Thank you very much for choosing our channel. We hope that you will enjoy these videos and you will learn a lot from these videos. Please do subscribe and like our YouTube channel and our videos also. You can go to Facebook to like our group. It is called Exclusive Investor or dash Forex Trading Guidelines. You can also like our group and join our group there. Again, I welcome you to Global Forex Academy, a division of the MFM group. We are a company, so all our materials are basically sold. So if you like us to teach you how to trade in the real professional manner, you can contact us and we'll be glad to lecture you and give you lessons on how to trade with a particular fee attached to it. Let us read our risk disclaimer. Let me enlarge it. It reads as follows. This video is for general information only and is not intended to provide trading or investment advice or any personal recommendation. The information in this video is indicative and may become out of date at any time. The producer or the people who are involved in this video shall not be responsible for any loss that you may incur either directly or indirectly, arising from any investment based on any information in this video. Any information relating to the past performance of an investment does not necessarily guarantee future performance. Please remember that trading and investing carries significant risk due to rapidly moving markets and may not be suitable for all investors or traders. Losses, especially when trading leveraged instruments, can in some cases exceed your account balance. That simply means you may lose all your money that you have invested in your trading account. You should therefore obtain independent investment advice and ensure you fully understand the risk involved before trading or investing in anything. The information contained in this video does not contain investment advice or recommendation on the purchase of or sale of any of our securities or the securities that you're trading. Okay, let us begin our lecture. Candlesticks construction. We previously left at what is a candlestick formed, or how is a candlestick formed? What is a candlestick formation, or how is a candlestick formed? We touched that. So we'll be moving to what are the two types of candlestick. This is video 2 of our previous video. Video 1 we ended where we talked about how is a Japanese candlestick formed. Video 2 we are continuing where we left off. What are the two types of candlesticks? We have two types of candlesticks, which are bearish and bullish candlesticks. Those are two types of candlesticks, bullish and bearish. The bullish candlestick is a buying candlestick, indicates the buying power, and the selling, it is called a bearish candlestick, represents the selling power. Okay, so we have a bullish and a candlestick, a bearish candlestick. A bullish candlestick is formed when the closing price is above the opening price. The bearish candlestick is formed when the closing price is below the opening price. Let's go back. The bullish candlestick is formed when the closing price is above the opening price. Look at your right side. You are looking at a bullish candlestick in the green format. That green candlestick is called the bullish candlestick. You can use any color that you like. You can modify it 90% to 99% of the traders, they use a white color for that greenish candlestick there. Again, 90% to 99% of the traders, they use the green color, but you can use your own typical color. So the candlestick opened below the closing price. As you can see, there's an arrow indicating open and there's an arrow indicating close up there. So that's how your bullish candlestick is formed. And then look at the bearish candlestick, how it's formed. It's formed when the closing price is below the opening price. Look at the red candlestick there on your right side. The red candlestick there represents the selling power of the trader. So the opening price is above there and the closing price is below. So that's how the two types of candlesticks are formed. What is the difference between a long and a short candlestick? A long candlestick signifies the higher market volatility. Now, look at these two candlesticks. They are both long candlesticks. So that simply means they represent that the buyers at the bullish candlesticks were many of them. And at the bearish candlesticks, there were many also in this particular time frame. And the short candlestick represents the low market volatility. If these candlesticks, they were half, short, half, let's say these two candlesticks, they were short as the part where it is between the real and the body. You see that indication there. If these two candlesticks were that half, we would say that the buyers were not so many at that time frame, and the buyer and the sellers were not that many at that time frame. So that's the difference between the high and the low volatility. Okay, and what are the advantages of Japanese candlesticks pattern? What are the advantages of Japanese candle patterns? Let me give you that definition there. The first advantage will be that one of it contains the unprocessed and the raw data about the market sentiment. And B, it provides unique insight on the relationships between the buyers and the sellers. And then C, it gives early signals of potential market trends. Now these are patterns. You will learn about them as we go on. You must understand that candlesticks trading, we call it price action. If you trade only candlesticks, you don't use anything else besides candlesticks, you will have to read and analyze the patterns, better known as price action. So you will make money also by trading candlesticks alone, because they give you these three characteristics, these three unique characteristics that you may use them as signals. Now let us look at signals of candlesticks pattern. And first of all, we have two types of candlesticks patterns. We have double candlestick patterns and we have single candlesticks patterns. So here we will start with the single candlestick pattern. Okay, let us start. The first example here will be that one of the hammer. Now let us go back to my first introduction on the first video. I spoke about there are 12 types of candlestick signals, generally and commonly appearing on your charts, daily charts, 1 minute chart, 5 minute chart, 15 minute chart, 4 minute chart, 1 hour chart, weekly chart, monthly chart, daily chart. These 12 patterns, they almost daily appears on your chart frames. So we'll be running through almost those 12 candlestick patterns that you may use to be profitable. You may use them as signals also. Okay, as a trader, you must know that you can use candlesticks as signals. Okay, so now, what are the patterns? What are the patterns of candlesticks? What are the patterns of candlesticks? A, they are unprocessed and raw data about the market sentiment. They are unique insights on the relationships between the buyers and the sellers. And they are signals, potential, giving you the market trend, or potentially they will give you the market direction. So the first example of a candlestick pattern will be that one of a hammer. Pardon me. Let me just take a break here. Okay, thank you. We are back. The hammer. Now, the hammer is a bullish signal. Why it is called a hammer? Look at your screen. You are looking at those two candlestick formations there. They have a huge box up there, whether green or red, and they have a long line going down, a stick, a wick going down there. Why is it called a hammer? You can notice that it looks like a hammer. Okay, a hammer, a tool that is used to nail nails. Okay, so that is a hammer. Some may call it a hanging man. Okay, those are the two definitions of this bullish pattern. So you can use this pattern as a signal. Okay, look at the construction of this candlestick here. It opened just there in the middle. I'm talking about the bullish one. Look at the bullish candlestick, the greenish one, the green color there. That is a bullish candlestick on your left. On your left, the one at your left. That is a bullish candlestick. That is a buying candlestick. Okay, look at it. It opened just there in the middle, and what it did, it pushed down that long wick, that long line. That's where after it opened, it pushed itself down to the lower shadow there, lower part. And it moved up to the point where it is indicated high. But what it did not move above the closing price. It stopped at that high level, and it also closed at that high level, leaving no wick. No wick was left there. No wick was left there. No shadow, no stick was left up there. So this gives you a clear indication that the buying power is on. It gives you the buying momentum. It tells you that now the buyers are coming in. Okay. Let's look at the right one, which is indicated red. That is a bearish candlestick. That is a bearish candlestick. Now look at where it opened. It opened just up there. Just up there where the previous candle closed. That's where this current candle now opens. Now look at what it did. It went where? It opened up there. Now can you guess where it went? It just shoots straight down to the low side. You see where it is indicated low? It went just down there, and it came up again, and it stopped where the previous candle opened. The bullish candle closed at that level. So these two candlesticks, they gave you the same price formation. They opened the bearish opened where the bullish closed, and the bearish closed where the bullish opened, but they both pushed down to the bottom. You understand that? So both of them, you can use them as a bullish signal. That simply means they give you an indication that an uptrend market is coming in. An uptrend market is coming in from a downtrend. Now let's look at how do you recognize this hammer. Okay, this single candlestick pattern. A. There must be a proceeding downtrend. Let me explain. What A means is that these two types of candlesticks pattern, they will appear when you have a downtrend, when the bearish candlesticks are formed in terms of selling power, when the market is going down, when the bearish are winning the market for the day or for that time frame period. So then, as you recognize that something is pulling the market up and it closed above where the previous candle opened, now you know that you are having the bullish buyers coming in. Point number B. It looks like a lollipop with a long stick. Yes, you can call it a lollipop, a hammer, a hanging man. Just give it a name that you can recognize by it. But generally, 90% of traders to 99% of traders, we use the term hammer or hanging man to identify this type of a bullish pattern. The closing price is above or near the opening price, forming a tiny body. So each candlestick, you can look at it. Where it opened is as near as where it closed. Both of them, bearish and bullish. Bearish and bullish. Both of them, they closed nearly at the same levels, but not at the same levels, but just close between. You can put a price of maybe 5 pips between there, or 2-3 pips between there, but not more than 5 pips between there. Okay, the real body could be green or red, depending on which power was there. Was it the bullish power, or was it the bearish power pushing the market at that time frame also? Okay, so let us move on. Let's look at number E. It has no or little upper shadow. Look at that. Look at up there where it is the bullish one, where it is indicated high. There's no shadow there or wick. You look at the bearish one where it is indicated high. There's no shadow there or a wick or a line. Okay. Number F. The lower shadow is at least twice or the length of the real body. Now look at that. Look at that wick, that long stick there, that shadow there. It is longer than the body itself. You see the body is that 4-corner box there. The green or the red corner, 4-corner box there. That's the body there. Now look at the wick, the shadow, the long stick. It is longer than the body itself. So this qualifies as a hammer, or it qualifies as a hanging man or a lollipop pattern. You call it whatever, for as long as you can recognize it and you can trade it. Now this is a signal of a bullish trend, an uptrend from a downtrend. This is a reversal pattern, we call it. Okay. Now, how do we trade it? How do we trade this example here? Look at it. How do we trade this? Where is your entry and where is your exit? Where should you put your stop loss? Where should you put your take profit? We'll look at those examples later. First of all, look for the hammer at the bottom of a downtrend. Now, this will appear at the bottom of a downtrend. I will look for examples in the real market segment, and I will show you how it appears and how you recognize it. Wait for the next candle to close above the high of the hammer to confirm the existence of a bullish force. Let me repeat. Wait for the next candle to close above the higher of the hammer. Now, what is the higher of the hammer? Look at up between these two candlesticks. You can see just above where it is written close, there's an indication of high. Where it is written open, there is an indication of high. From the bullish close, there's a high. From the bearish open, there's a high. So there will be another candlestick that needs to form. Now, whether that candlestick will form next to a bullish candlestick or a bearish candlestick, but the bottom line is that candlestick has to be a bullish candlestick, not a bearish candlestick. If a bearish candlestick appears next to a bullish candlestick and it closes at the lower shadow of the hammer, that does not qualify as a bullish trend. You have to wait again for a doji to appear, and then you have a bullish candlestick appearing and closing above the higher of the hammer or the hanging man there. Okay, so number C, opening a long position upon confirmation. Now, once you notice that the second candlestick appearing next to your hammer, it is a bullish candlestick. Let's look at an example of a bearish candlestick here. This one here at your right side. Is it right? Yes, it's right. At your right side, look at the red candlestick there, the hammer there. If a candlestick will appear where it is indicated open, another candlestick appears there, and it opens where? And it opens there, right there where it's written open there, the coming candlestick opens there, and it pushes up, and it is above that high. You see that high on top of that red candlestick there, that hammer, and that next candlestick opened there, and it pushes up, and it closes above this previous hammer candlestick. Then you can open a long position. That simply means now you are entering the uptrend pattern. So that simply means you may go into your bullish momentum now. You can buy that market there. Number D, place a stop loss below the low of the hammer. Now, the stop loss will be as down as far as where it is indicated low. You see here, where it is indicated low, that's where your stop loss will be. Okay? Okay. And then take profit, because I didn't indicate about take profit here. Your take profit, you can do it as the same length as your close and your low from your bearish candlestick or your opening and your low bullish candlestick. That same long distance can be turned into your take profit at that time. Okay. Are we good? Most definitely. Can I move on to a single candlestick pattern shooting star? Do we have time for that? No, we don't. Okay. Let us end there. Let us just stick with this one pattern called the hammer. Review this video and familiarize yourself with all the information in this video. For educational purposes, you may apply this education in your Forex trading. And please be careful when you trade. Be careful when you trade. It is not 100% guaranteed that every time when you trade you will make profit and profit and profit. There will be trades that you will lose. I'm talking about billionaires who have lost trades in a row, monthly basis. However they trade, they lose trades. I'm talking about experienced traders and investors. They lose positions. So when you trade, you must know that there will be days where you will lose, but apply what we call financial management system to your trading. Every single day, put a percentage of loss that you may handle. Every single day, calculate your total net or your net worth, how much you have in your trading account. And make sure that you calculate how much you can afford to lose, but not to say you are setting yourself to lose, but losses will always be there. So, calculate how much you can lose, and if you do lose, how will you reconciliate your losses? How will you get back your losses? Calculate your profits. Now, say if I lose 5% of 5 trades that I take, how much should I win trades? How many trades should I win, and how much should I put on each trade? How many percentage should I invest to get back my losses? Sometimes you don't need even to get back your losses. Just trade to succeed. Trade to make profit. Okay. Thank you very much for joining us. I definitely enjoyed myself doing these videos. I hope you too will enjoy our presentations and lectures. Again, do like our videos on our YouTube channel. Our YouTube channel is called Exclusive Forex Traders Academy, or Forex Trading Academy. You will see that face of mine appearing there, and that will be our YouTube channel. Our Facebook group is called Exclusive Investors Forex Trading Guidelines. That is our Facebook group. You can go there. You will see my post there. I post most of my trades, my live trades. I shoot them, and I screenshot them, and I put them on that group, and I post them there so that you can see what I'm teaching, is it relevant or not. Because most of the time you'll have people telling you that they are teaching you how to trade, but consistently they are not making any profits, or they are not making good trades. So I'm posting most of my wins and my losses also. I'm not focusing only on my wins. I also put my demo account losses there, and my real account losses there. I've blew up many accounts. I'm still struggling. Even today, I'm still learning how to trade, because most definitely, I'll tell you the truth, the market changes daily, so you can never say I know how the market operates. I don't lose trades. I've met people who claim that they don't lose trades, but later on you see them crying that they've lost trades. So that's how it is. Thank you very much for joining us. I hope that you enjoyed our lecture, our company videos. I hope that you will continue watching our videos. Thank you very much for joining us. Hey,